Welcome back to the deep dive. You know, usually when we talk about the next big thing in the markets, we find ourselves looking at software. We're looking at the app or the algorithm.
Or the code, the intellectual property.
Exactly, the invisible stuff that lives in the cloud. But today, looking through this massive research stack you sent over regarding a company called Iris Energy, or IREN, as the ticker says, it feels like we're looking at something much heavier.
Oh, absolutely. Concrete, steel cables.
Right, and just massive, massive amounts of electricity, because we are looking at the absolute collision point of the two most hyped, volatile, and transformative sectors on the planet right now, cryptocurrency and artificial intelligence.
It is such a fascinating place to be. You have the digital gold rush on one side and the intelligence revolution on the other. And standing right in the middle trying to bridge that gap is IREN.
Yeah.
And you're right, it's not about the code for them. It's really about the engine room.
The engine room. I like that. Because, I mean, everyone is obsessed with the brain of AI, right? The models like GPT-4 or Gemini. But IREN feels like a case study on the body of AI, the physical infrastructure required to keep that brain alive.
That is exactly the right analogy.
Yeah.
We are looking at a company that is attempting a massive evolutionary leap. I mean, if you looked at IREN 2 years ago, you saw a pure play Bitcoin miner.
Right.
But if you look at their fiscal year 2025 results and their projections for 2026, you were looking at something else entirely. They are pivoting to become a high-performance computing powerhouse.
And that is the central tension we really need to unpack today. Because on paper, that sounds great. Hey, let's do AI. Everyone loves AI. But in reality, that is like a gold miner suddenly deciding to become a manufacturer of supercomputers.
Yeah, it's completely different.
It's a totally different business model. So the mission for this deep dive is to figure out how a company known for mining digital coins successfully pivots to high-performance computing without losing its chirp.
Precisely. We need to look at their massive operational changes, the aggressive targets they've set for 2026, and the financial reality behind what they reported as a 168% jump in revenue.
Which is wild.
It is. But we have to ask, is this sustainable, or are they just surfing a very expensive wave?
Well, a 168% jump is a huge number. But let's start with the old world first, because to understand where they're going, we really have to respect where they came from. They call this their dual engine strategy, right? Engine number one being Bitcoin.
Correct. And we shouldn't dismiss it just because AI is the new shiny object. IREN built its foundation on Bitcoin mining. In fact, looking at the recent data, they hit a massive milestone, 50 exahashes per second in mining capacity.
Okay, let's pause there. Exahashes. We hear this term a lot in crypto circles, but for you listening who maybe doesn't have a mining rig in your basement, let's put that number in context.
Sure, it's a staggering amount of compute. An exahash is 1 quintillion hashes per second. Doing 50 of those puts IREN comfortably among the largest Bitcoin miners in the world.
It's industrial scale.
Highly industrial. Usually when a company hits a target like that, the very next announcement is, well, we're going for 100.
Right, you double down. That's the playbook.
Exactly.
Yeah.
But IREN did something totally unexpected. They hit 50 exahashes, and then they essentially slammed the brakes.
They just stopped.
They paused all further mining expansion.
That is the twist here. They have this cash cow, this massive mining fleet, and they just say, okay, that's enough for now. Why stop feeding the beast?
Because they saw a much bigger opportunity. They realized the farm could be used for something far more profitable. They're taking their most valuable assets, which surprisingly aren't the mining machines themselves, but the power capacity and the data center slots.
Ah, the real estate and the electricity.
Exactly. And they are pivoting those resources toward engine number 2, which is AI cloud services.
So this is the GPU as a service model.
Right. And there is a fundamental technical difference here that explains the why. Bitcoin mining uses ASICs, application-specific integrated circuits. Those chips do one thing and one thing only. They mine Bitcoin.
Right, so if Bitcoin goes to zero, those chips are essentially fancy paperweights.
Zero resale value outside of crypto. But AI uses GPUs, graphics processing units. These are flexible. You can use them for gaming, for rendering movies, or for training the most advanced large language models on Earth.
So by pivoting to GPUs, IREN is moving from a single-use tool to a multi-purpose, high-demand tool.
Exactly. They are diversifying their risk.
But looking at the data here, it seems like a pretty risky bet to pause your main revenue source. I mean, as of late 2025, 96% of their sales still came from Bitcoin.
And that is the critical detail. The revenue mix right now is overwhelmingly Bitcoin. But the growth narrative, the reason the market and investors are watching them so closely, is entirely on the AI side.
They're betting the demand for AI compute is going to completely outstrip the demand for Bitcoin hashing.
In terms of profitability, yes.
It is bold. It really is. It's like stopping the expansion of your oil rig to build a solar farm because you think that's where the future is, even though the oil is paying the bills today.
And to make that switch, you need hardware, a lot of it. Which brings us to the sheer scale of their ambition. We aren't talking about buying a few servers here.
No, the numbers here are frankly staggering. They're scaling from around 1,900 GPUs to a target of over 23,000 NVIDIA GPUs. And we aren't talking about consumer-grade stuff. These are H100s, H200s, and the new Blackwell chips.
The Blackwells are the key.
Yeah.
Being able to secure those chips is an absolute game changer. They have achieved NVIDIA preferred partner status.
Which means what exactly? In a world where you have Elon Musk and Mark Zuckerberg literally fighting over chips, how does a Bitcoin miner get priority?
It means they've proven they have the physical infrastructure to actually run them. In this incredibly supply-constrained world, that status is like having a golden ticket. It means when NVIDIA ships the new hardware, IREN actually gets it.
And the revenue targets associated with this are super aggressive. They're aiming for an annualized revenue run rate of over $500 million from AI cloud alone by Q1 2026.
Yes.
That is $500 million from a business segment that barely existed for them a year ago.
It is aggressive, yes. But here is where we need to connect this to the bigger picture for you listening. Why IREN? Why would Microsoft or any other AI giant rent space from a Bitcoin miner? Why not go to Amazon or Google? Why not just build it themselves?
That's the billion-dollar question. What is their moat? Because just buying chips isn't a moat. Anyone with billions of dollars can buy chips.
Correct. The moat is the infrastructure, specifically the power. You see, in the world of AI, chips are expensive, but power is scarce. Getting a new grid connection for a massive data center in the US right now can take 5 to 7 years.
5 to 7 years. So if I'm Microsoft and I need compute today, I literally can't wait for the grid to catch up.
Exactly, you can't. And IREN has already secured nearly 3,000 megawatts of power capacity.
3,000 megawatts, that is roughly 3 gigawatts. To put that in perspective, that is enough to power a medium-sized city.
And not just any power, they focus entirely on 1% renewable energy, hydro and wind. But here is the real kicker. Look at their Childers, Texas site. Their power cost is around 3.3 cents per kilowatt hour.
3.3 cents. I was looking at my own electric bill this morning, and I promise you I am paying a lot more than that. The industrial average has to be double or triple that in most places.
Easily.
Yeah.
In the data center world, 3.3 cents is almost unheard of. That low cost is their true competitive advantage. It means they can run these incredibly power-hungry chips cheaper than almost anyone else on the market.
So they have the cheap power and they have the land. I saw mention of a couple of specific projects here in the research. Horizon 1 and Sweetwater. What are these?
Horizon 1 is their flagship facility for the AI transition. It's a liquid-cooled AI data center.
Liquid-cooled.
Right, which is important because these new NVIDIA Blackwell chips run incredibly hot. You can't just blow air on them like a normal server farm.
Yeah.
You need advanced liquid cooling infrastructure. Horizon 1 is designed specifically for that next-gen high-density computing.
Got it. And Sweetwater.
Sweetwater is the behemoth. That is a massive 2-gigawatt hub in Texas. That is the kind of scale that attracts the hyperscalers, the Googles and Microsofts of the world.
Speaking of hyperscalers, we have to talk about the Microsoft deal. Because I feel like this was the moment the market sat up and said, okay, these guys are actually serious.
It was a massive validation point. A $9.7 billion agreement with Microsoft to deploy AI cloud infrastructure. When a trillion-dollar company like Microsoft signs a deal of that magnitude with you, it proves you aren't just a small crypto player anymore.
Right.
It proves your infrastructure is up to the rigorous standards of the biggest tech companies in the world.
$9.7 billion. That is a number that's just hard to wrap your head around. It certainly changes the narrative from crypto miner to AI infrastructure partner.
It absolutely does.
Yeah.
But contracts are one thing, actual financial performance is another. And this is where the story gets really interesting from a numbers perspective. We witnessed a massive turnaround in fiscal year 2025.
Yeah, let's look at that aha moment on profitability. Because FY 2024 was, well, it wasn't great. They had a loss of nearly $29 million.
Right, but they were burning cash to build capacity. That's the construction phase. But look at FY 2025, net income of $86.9 million.
That is a complete reversal.
Total revenue hit $501 million. which is that 168% jump we mentioned earlier.
And the adjusted EBITDA earnings before interest, taxes, depreciation, and amortization surged to almost $270 million. That is nearly a 400% increase.
It shows that the operational leverage is really kicking in. Once you build the data center and plug in the machines, the margins become incredibly robust.
Speaking of margins, I saw a number in the report that genuinely made me do a double take. The gross profit margin is around 68%, which is great. But the AI cloud hardware profit margin, it was reported at nearly 98% in mid-2025. 98%? Is that even legal?
It sounds impossible, doesn't it?
Yeah.
But you have to understand exactly what that metric represents. It's the hardware profit margin. It means for every dollar of revenue, the machine generates the direct operating cost, which is mostly just electricity, is only 2 cents.
Oh.
That is the direct benefit of that 3.3-cent power in Texas we were talking about.
So the machine literally prints money and it costs pennies to run?
Effectively, yes. However, and this is a very big however, that doesn't account for the massive capital cost of buying the machine itself, or the building it sits in, or the interest payments on their debt.
Right, right. It's not net profit. It's just showing how efficient the engine room is. But that brings up a great point. The cost of buying the machines. These NVIDIA chips are astronomically expensive. How are they paying for all of this? They certainly aren't doing it out of pocket.
No, they aren't. And this is where we get into their financing strategy, which is a bit of a high-wire act, honestly. They have been using a convertible note strategy. They raised a significant amount of money recently. For example, $875 million in notes due in 2031.
Okay, let's unpack convertible note for the listeners, because that sounds like fancy Wall Street jargon for debt.
It is debt, but with a very specific twist.
Okay.
Ideally for the company, they borrow this money, but instead of paying it back in cash with interest, they hope their stock price goes up enough that the lender chooses to convert the debt into shares of the company instead.
So they are betting heavily on their own stock price rising.
Exactly. It's a classic growth at all costs financing model. Now, their debt-to-equity ratio is currently moderate around 0.34, which is fairly healthy.
Yeah.
But they are absolutely banking on this AI pivot working perfectly. So the stock soars, the debt converts to equity, and they don't have to drain their cash reserves to pay it back.
That feels like a very confident bet, but also a uniquely risky one. Because if the stock tanks, they still owe that money in cold, hard cash.
That is the risk. And that leads us nicely into the market sentiment overall, because not everyone is fully convinced this is a slam dunk.
Yeah, the stop chart definitely looks like a roller coaster. A 52-week range from $5 to nearly $77. I mean, if you bought at 5, you are a genius. If you bought at 76, you are probably stressing right now.
And that extreme volatility is exactly why we saw JP Morgan issue a downgrade recently. They moved IREN from overweight to neutral.
Why, though? If the numbers are so good and revenue is up 168%, why the downgrade?
It wasn't because they think the company is fundamentally bad. It's entirely because of valuation. JPM's argument is that the stock is now priced for perfection.
Priced for perfection. That is always a scary phrase for an investor.
It really is. It means the market has already priced in the absolute success of the AI pivot. The easy monies have been made. Now, IREN actually has to execute flawlessly just to justify the current stock price. Any slip-up at all, and the market could heavily punish them.
And what are those slip-ups? Like, what are the specific execution risks that could cause them to stumble here?
Based on the research, there are 3 main ones we need to watch. First is the supply chain. They desperately need those NVIDIA GPUs delivered on time. If NVIDIA has a manufacturing delay, or if TSMC has a fabrication issue, IREN misses its revenue targets.
Because you can't rent out chips you don't actually have.
Exactly. And we know global supply chains have been notoriously messy lately.
What's the second risk?
The ghost of crypto past, basically.
Yeah.
Bitcoin volatility. Remember, 96% of their revenue is still coming from Bitcoin today. In November 2025, Bitcoin dipped below 90K.
Which still sounds incredibly high historically, but for miners tight margins, that kind of drop hurts.
It really does. It impacts their base revenue immediately. If we enter another crypto winter before the AI revenue fully ramps up to that $500 million target, their cash cushion gets very thin. They need Bitcoin to stay healthy while they build the AI side.
Makes sense. And the third risk?
Cost of revenues. We talked about the cheap power, but utility prices are not static. In Q1 2026, their cost of revenues jumped about 52%, partly due to increased utility prices.
Ah, okay. So if energy costs spike across the board, those beautiful 98% margins we talked about start to shrink pretty fast.
Exactly. It's a race.
Yeah.
Can they build the AI infrastructure and secure the long-term contracts fast enough to offset the inherent volatility of Bitcoin and the rising costs of expansion?
That is the race. And they are running it against some very well-funded competitors right now. So let's bring this all together. What does this actually mean for you, the listener? We have a company here that has effectively bridged the gap between the crypto winter and the AI summer.
Right. IREN is at its core a renewable energy powerhouse. That is their true identity. They figured out that the most valuable commodity in the 21st century isn't just data, and isn't just money. It's the physical energy required to process that data.
They're essentially the power plant for the digital brain.
Exactly. They have successfully positioned themselves as an infrastructure bottleneck breaker. Energy is the ultimate bottleneck for AI right now. IREN has the power, and they have the land. That makes them a target and a leader.
But with that kind of leadership comes a lot of vulnerability, too.
It does. And here's a provocative thought to leave you with today. We see hyperscalers like Microsoft getting involved directly with deals like the one IREN just signed. We see Amazon buying nuclear plants directly just to power their data centers.
Right, the big guys are trying to own the whole stack.
Exactly. So how long does IREN actually stay an independent operator? If their infrastructure is so critical and their 3 gigawatts of power contracts are so intensely valuable, do they eventually just get swallowed up by a big tech giant?
That's a fascinating angle. Why rent from IREN when Microsoft can just buy IREN?
Precisely.
Hmm.
Or looking at the other side of the coin for a second.
Right.
If the AI bubble has a hiccup, if the hype slows down and companies stop renting H100s at these exorbitant rates, can their Bitcoin operations keep the lights on when they have billions in convertible debt hanging over them?
That really is the billion-dollar question. Are they the future of independent AI infrastructure, or are they just a delicious snack for a trillion-dollar tech company? Or are they perhaps over-leveraged on a trend that might cool off?
It is a massively high-stakes pivot. But one thing is for sure, if you want to understand where the market is going next, don't just look at the chip makers. Look at the power lines.
Follow the energy. That's the real lesson here.
Follow the energy, absolutely.
And for you listening, you might want to take a look at energy derivatives next. It feels like that's where the smart money is heading to hedge exactly these kinds of bets. Thank you so much for joining us, and we will see you on the next deep dive.
Take care, everyone.